Good afternoon, everyone. This is Nick Vlietstra. Welcome to all of you to our April session of the Bank Council Roundtable. I also want to extend a special welcome to the CFOs and Treasury staff of our bank and non-bank clients, and to members of the media who are joining our usual group of Bank Council for this special edition of the Roundtable. Thank you to all of our attendees for joining us today. Please remember to sign in on the attendance sheet we've provided and return it to attendance@dorsey.com. If you're looking for your attendance sheet or for today's presentation materials, they're available for download from Dorsey's webinar reminder email sent to you earlier today from events@dorsey.com. We've planned a 60-minute presentation entitled The Stimulus Bills, Federal Regulatory Agencies, and the Federal Reserve, Bank Challenges and Opportunities. Next slide, please. We have 3 speakers on the panel today. They are Ken Logsdon, Joe Lynyak, and Tom Scanlon. Ken is a partner in the firm's finance and restructuring group and focuses on commercial lending matters, including expertise in SBA lending. Ken is located in the firm's Salt Lake City office. Joe Lynyak is a partner in the firm's finance and restructuring group as well, and he's a member of the banking and financial institutions industry group. He's also co-chair of our financial services regulatory group, and he practices in the firm's Washington, D.C. and Southern California offices. Tom Scanlon is of counsel in the firm's finance and restructuring group, and is a member of the banking and financial institutions industry group with a focus on financial services regulation. Tom is located in our Washington, D.C. office. Due to the stay-at-home restrictions, our panelists are calling in from a number of locations. There's a chance that sound quality will vary, but we will do our best to maintain it to be as uniform as possible. Likely there won't be time for a Q&A session at the end of today's presentation. So if you have questions for our presenters following today's presentation, you can email or call them later using the contact information that was provided on the slide that was just up, slide 2, or it's also found in their bios, which are at the end of the presentation deck that we've given you. Or please call your usual Dorsey and Whitney relationship contact with questions. Let me quickly run through our agenda today. Our presentation will address the economic stimulus provisions of Titles 1 and 4 of the CARES Act. With respect to Title 1, the presentation will cover impacts on the current SBA lending programs and the newly created Paycheck Protection Program. With respect to Title 4, the Coronavirus Economic Stabilization Act of 2020, the presentation will discuss primarily Section 4003's emergency relief and taxpayer protections. Speakers will then turn to consumer protection provisions and other select provisions of the CARES Act, and then they will cover some risk management considerations, bank regulatory advice and guidance, and Federal Reserve monetary policy actions. There's a lot to cover, and so our presentation today is intended to highlight issues of concern to our clients and is not an exhaustive treatment of all the items raised. You can find additional information on the Stimulus Act by going to our website at dorsey.com or by contacting us directly, as I've already mentioned. And with that, I'm going to hand the microphone off to the first speaker, Joe Lynyak. Thank you, Joe.
Oh, thank you very much, Nick, and good afternoon, everyone. I hope everyone and your families are safe and healthy. To start out, what we'd like to do is talk a little bit about some overriding issues which I think are going to permeate this presentation, and you're going to be thinking about them from a number of perspectives, including risk management, which we will end up the presentation on. Perhaps starting out, in terms of issues, one of the ways of viewing this is the old saw about finally the dog catches the car, and then the dog thinks, what do I do now? Well, you know, we're talking about $2 trillion worth of stimulus, and the Treasury, SBA, and the Fed have got to figure this all out. And a couple of questions to perhaps think about is, will the Treasury use the current paradigm for SBA lending, or will they modify the SBA application process and funding protocols to radically ramp up loan production? And then in terms of Title IV, which is $500 billion, how is the interface between Treasury and the Federal Reserve Board supposed to function? Just so we can establish a baseline, for those of you that may not be too familiar with SBA lending, the current SBA approved lenders model is an originate and hold model whereby the lender receives SBA insurance, and on the back end, a percentage of the amount is guaranteed by the SBA. If the same process applies, issues that have got to be considered by you as a bank are as follows: regulation and program guidance, scalability, application and documentation, funding, lender capability, timing, the expiration of the lending programs, and counterparty considerations. And in that regard, just a few things to think about. The regulations and the program instructions are slowly trickling out, far slower than the promise by the Treasury, and in many cases, not very helpful at all. We are going to look at that. It's probably going to be a process that's going to evolve, but every time you look at these programs, new questions come up which are going to require clarification by the by Treasury or SBA or the Fed. Scalability. Last year, the SBA guaranteed about $27 billion worth of loans. Now it's up to $350 billion. Estimates range for the new SBA program between 50 to 75,000 applicants, possibly well over $100,000 for both programs. Does the scalability being designed, is that going to work? Application and documentation. Well, we've got the existing SBA program, which Ken is going to talk about, but then we've got the new program, we've got Title IV, and we've got loan terms and conditions which have not yet been written. Whether or not that's going to be posted someplace, whether or not Treasury is going to have to write them. And in the background is an issue: must the bank engage in some degree of due diligence in order to be able to protect itself? Funding and lender capacity. The current SBA process requires lenders to extend credit and to fund with back-end reimbursement and a purchase program, which potentially could be very, very complicated based upon the fact that the SBA is going to be inundated with over $350 billion of reimbursements. In terms of lender capacity, the SBA new loan programs exempt banks from the risk-based capital requirements, but not from the other capital requirements that the banks are subject to, which means that depending upon the size of your bank and what your capital is, you may quickly exceed your lending capability under either the Title I or Title II. So there's a problem here and banks are going to have to watch that. The timing of the programs. The expiration of these programs is frankly not realistic. And in most cases, it's June 30th of this year. The government is very, very slow in rolling out the programs. I suspect this will have to be extended. And then there's also counterparty limitations. Just to note very quickly, if you have a borrower who is a business, that business may be subject to existing credit facilities. Those credit facilities may severely limit the ability of the borrower to take on new credit, raises issues in terms of loan document review and so forth. And again, a lot of information which may be required on the part of a bank involved in these programs in order to conduct reasonable underwriting and due diligence. So those are things to begin to think about as we go through these slides now. And what I'd like to do now is turn it over to my partner, Ken Logsdon, to talk to you about Title I and the new SBA programs.
Thank you, Joe. Appreciate that. So just to begin and to reiterate here, this is a massive undertaking by the federal government. And it goes without saying, this has never been done in human history. And I don't think that's hyperbole to emphasize how complicated this is going to be. And by the end of this webinar, you're going to have some details about what the latest is that we know of, and it's already shaking out to be a much more complicated process, and the timeline's not looking like, I would say, the Treasury and SBA had hoped, but we'll talk a bit about that at the end. To dive right in, you got the SBA programs that were implemented under the CARES Act. There was two things that it did with respect to the SBA. It essentially broadened the disaster relief program, and it also instituted what's been called the Paycheck Protection Program. We're going to call that the PPP. That's where most of the focus has been from the business community over the last week or two. Though the disaster relief component is very helpful for a lot of small businesses, that is more or less a traditional loan that will have recourse features, i.e. requirements for guarantees and collateral. It'll have a feature that requires repayment because it is a loan. It will not be forgiven. But the upside to the business community that are looking to take advantage of that program and are comfortable with the collateral and guarantee requirements, there's a very streamlined application process. So we've been emphasizing with our client base that can take advantage of that program, show that they don't have access to credit elsewhere, and that they've been substantially impacted by COVID-19, to strongly consider that route because it's already in place, and right now it's looking to be the more efficient route. But in this presentation, we're going to focus more on the details around the PPP. As Joe stated earlier, they've set aside, Congress and the President have decided to set aside $350 billion for what's going to be covered loans. That's loans are going to be made between February 15th and June 30. With respect to the disaster relief loan, they did up what has been set aside to that to approximately $50 billion. Your annual SBA programs in total, usually last year I believe was approximately $20 billion, so it's over double the size. Under the disaster relief loan program, the requirements for lenders to participate are a little bit more stringent. With respect to the PPP, it's been opened up to include far more financial institutions, and we'll talk a little bit about that here in just a moment. Next slide, please. Okay, so under the PP loans, you have what's called an eligible borrower. And what was interesting, if you look at the act, it actually opens up with any business entity, and it says including, right? It says including small business concerns, any business, nonprofit, veterans organization, tribal business concerns, certain independent contractors, and self-employed individuals. And that's an interesting opener because it says, in addition to or including small business concerns, that has raised some questions in the legal community as to what was being signaled there. One question that jumped out to me was this an indication that perhaps any business was not supposed to adhere to the standard SBA rules for all sorts of related items, i.e. eligibility questions? What we're finding is that wasn't the intent. The applications that are being produced certainly do include and require disclosure of information that speak directly to questions like eligibility. Entities that are participating in activities that are illegal, activities such as gambling, there's other lists, there's a long list there. But there is still some confusion around that because there are institutions on the non-eligible list that probably should have access to this program. So that's in flux. But right now, until we hear further from the SBA, we need to work under the assumption that the SBA rules are essentially in place already, and they're going to be the gap fillers. If the Act doesn't speak to it directly, then you have to look to the underlying rules for guidance. The big number here, the magic number for this particular program, is 500 employees or less. And that's incredibly important for many of these larger companies that are either right there at that number or just over it, and how they determine whether they have 500 employees or not. It's essentially a look back over a 1-year period to average out the employee base. And that really makes a big difference. And it's an unfortunate situation because you have companies that are just over that number. And unfortunately, unless they actually can take advantage of otherwise SBA size standards that are already in place that speak to a larger number, which is important to keep in mind, because they do have the option, if they are a company that actually has a size standard more than 500 employees, they can use that for purposes of approval. And if they don't have that luxury, then unfortunately this may not be the program for that particular company. The important extra feature here when it comes to size standard, it's not just 500 employees of the applicant. there is what we have to do to take a look at what's called the affiliate question. We'll speak to that a little bit more, but that has been raising a lot of questions and a lot of uncertainty, especially as this program progresses. The loan amount it's pretty simple analysis. It's essentially 2.5 months worth of payroll costs. It's going to be the lesser of that number, or $10 million. Next slide, please. Now, use of proceeds. It's a pretty straightforward list. Use of proceeds. It's going to be towards payroll costs. It's going to be towards mortgage payments, real and personal property mortgages, utilities, rents, and importantly, those are those arrangements that were subject to agreements in place on and prior to February 15th. Next slide, please. So as for the recourse or non-recourse nature of this loan, some have described it as a grant. That might be somewhat accurate, but it is a little misleading. I think it's important to realize that this is a debt obligation right out of the gate. It's contingent that it might be a grant like a loan facility, but I think it's important to remember that. And that's important to emphasize for the lenders that are listening to this. You've already probably got inundated with many of your customers that have said, hey, we need some flexibility because our debt docs don't permit additional indebtedness. A lot of lenders have just started to send the message that they're going to allow for blanket waivers for their clients and customers to take advantage of this program, which I think is appropriate. Politically, it'd be difficult to say otherwise. But it is seen that way, so it's important to keep that in mind, even though it might be forgiven on the back end. And there is also no guarantee and no collateral requirements. The one caveat to the no guarantee feature and the non-recourse feature is if there's an improper use of proceeds, if the funds are used for other purposes, technically the Act contemplates recourse against the owners. So that's important to keep in mind. The term of the loan is expected to be no longer than 10 years and an interest rate not to exceed 4%. Let's pause there. This is where things start to get interesting. The guidance that has been put out to the community already, and this is just within the last 48 hours, is for the lenders to be comfortable having terms of 2 years and interest rates of no higher than 0.5%. And so already we're starting to see the Act diverge from how this is actually being implied in practice. The deferral feature remains in place, and simply once the loan is out there, the applicant or borrower will not be required to maintain principal or interest payments for at least 6 months and up to as long as a year. Borrower requirements, there's got to be a certification that they've been impacted by COVID-19. They have to say that they'll be using the funds for permitted uses. They were in business February 15th. That's important. They had employees. That's important as well. Next slide, please. As for compensation to the lending community, this slide here actually breaks down the fees that the lenders are entitled to receive. 5% for loans $350,000 or less, 3% for $350,000 to $2 million, and then 1% for over $2 million. Now, it's important to emphasize that this is not just a fee to the lender. This is going to be a fee to all agents, counsel, and other third parties that assist in the application process. They need to share in on this fee. So that's important to keep in mind. Here again, we mentioned the 4% interest rate, but in practice, that's not looking to be the case. And there is going to be no fee charged by the SBA. So that's also important due to the nature and intent here. That makes perfect sense. Next slide, please. All right, the forgiveness feature is going to be tied to certain expenses. And the clock starts to tick the day the loan is actually funded. And there's an 8-week period in which use of proceeds of the loan are used towards payroll expenses, rent, mortgage, and utilities. It looks a lot like the use of proceeds restrictions. It essentially is the same list. One particular nuance to keep in mind there, though, when it comes to debt obligations, and it does read broadly, real or personal mortgages as it's stated. It's lowercase. I think the intent there is real or personal property debt obligations, such as purchase money or capital lease obligations, that you're only going to be getting forgiven, or the applicant's only going to get forgiven for interest on those types of obligations. So for purposes of taking a look at a purchase money or capital lease arrangement, it might be a little tricky to kind of parse exactly how those payments are being made, but you just got to make sure that you're tracking the interest. The borrower will be required to submit documentation supporting all those expenses, and that will be the amount that will determine the forgivable amount. Any excess gets termed out into a regular loan, and it'll be subject to the interest rate that was put in place at the outset of the loan. And then for purposes of the lending community and the banks out there that are participating, within 90 days of the processing of an application for forgiveness, they can be expected to be compensated for that loan amount. Essentially, the SBA will purchase that from the lenders. Next slide, please. Okay, administration. So the participating lenders are authorized and approved to make these loans. It's designed to be a front-end administration process, if you will. That's how I like to look at this. Because of just the size and the scope of this massive program, the only way Congress thought it made sense to roll this out was to put it on the front lines of the business community, i.e. your local financial institutions. So theoretically, these lenders are giving wide latitude and deference to process these applications. Importantly, the act itself actually bakes in what is required for a lender to consider an applicant for purposes of processing the application. It's a very, very short list. It is the company was in existence February 15th, and they actually had employees. And that was assuring to see that it was a pretty low standard. But we're going to talk here briefly in just a moment about the new application for lenders that's hot off the press. And we're finding that it's going to be a far more complicated process than it would first appear. Importantly, for capital regulatory requirements, there's a risk weight of 0% for these loans. That can be helpful. There's some modification terms in the act that allow these lenders and banks that are participating to modify without having this to be a TDR or troubled debt restructuring. And lenders are to be paid origination fees by the SBA, as we discussed earlier. And then here on this slide, you see that we talk a bit about the agents. Next slide, please. Treasury Speaks. Okay, so here, this is the guidance we got within the last 48 hours. We saw the SBA and Treasury had put out to the business community sample applications and also guidance around the program. It wasn't terribly assuring because it seemed to deviate from what the act had to say. One particular instance was the forgiveness feature. The forgiveness feature, there was a statement in the sample application that essentially said, applicants need to be prepared that no more than 25% of their expenses that are in the form of non-payroll will not be covered for forgiveness. If you take a step back and consider the public policy purposes behind this act, and specifically the PPP, maybe that's not paycheck protection program to allow funds to get to the employee, the average Joe and Jane on the street. So from that lens, it's not too discouraging to see these kinds of limitations coming into the program. But I think it is important to note that that wasn't intended in the act, at least on the surface. Let's see, the forgiveness feature, what it's just important, it is going to be tied also to whether a company has rehired or restored salaries of the employee base. So for example, though the expenses that are going to be forgiven are going to be tied to that 8-week period, if there happens to be a layoff prior to obtaining the loan, and by the way, prior to April, the 3rd week of April, I believe it's April 25th, layoff and reductions in salary won't count against the applicant if they restore the employment status or salary, as the case may be. But they have to do that by June 30. So there are features there to watch out for. And then the underwriting requirements here, we listed, it says the borrower is in operation February 15th. They paid salaries and payroll taxes, i.e. they have employees. This went further, verification of payroll taxes, and then you have to, of course, implement your know your customer rules, your KYC rules. Now, these last two items are new items to the list. And so that was something that jumped out at me, that the bar had already been raised just a touch for the lenders that were considering participating in this program. What we have now seen very recently, just as of a few hours ago, a new form has been put out for purposes of the lenders to submit. It's called the 2484 form. And it's the title of this form is the Paycheck Protection Lender's Application. If you take a look at this form, there's quite a bit in this form, and this is something that gets completed by the lender, and there are numerous items to be certified to, and they speak to very complicated issues that are touched upon in the Act, i.e. the affiliate rule that asks for an affiliate analysis if necessary. So seeing this form is a signal so far from the Treasury and the SBA that a little bit of work is going to need to be done by the lending community in the application process. So this is all moving very quickly though. So this could change in a matter of days, but as we see this roll out, the complexities are starting to build. And with that, I'll turn it back over to my colleague, Joe.
Now we're going to turn to the Title IV and the Treasury and Federal Reserve Board stimulus and talk about what's in there and what Treasury and the Federal Reserve Board have done since the passage of the bill. That quick summary is virtually nothing, but we'll talk anyway. This component is outside of the small business stimulus. It's $500 billion, of which about $50 billion goes to air carriers and national security businesses, leaving approximately $454 billion to be used either by Treasury or by the Federal Reserve Board or by both. It provides enormous flexibility to the Treasury to structure loan and guarantee programs. And I would want to hold here and just note to the banks that this is a real significant issue which has to be resolved very, very quickly, whether we are talking about direct loan programs where the money coming from the Treasury or from the Federal Reserve, or whether or not the federal government intends banks on these larger loans to be extending credit directly and to receive a guarantee. And I know what you're all thinking. For this amount of money, I'm going to be very concerned as to what the guarantee states, which is going to be raising that as a high priority before you decide to enter into the program. And of course, as part of this, there are numerous employee and consumer protections, some of which we're going to speak about in a little bit. Now, there's two components to the programs. One are their general terms, in that in no event can the loan be more than 5 years. And unlike the Title I and the PPP program, the loans cannot be forgiven. As part of it, if you've got registered securities, you cannot repurchase securities until 2 months after repayment. You can't pay dividends for 2 months until after you completed repayment. No reductions in force until September of 2020, greater than 10% of the workforce. And a certifications by business is going to be required. Now, that could be the devil in the details as to what it is you've got to give. And this Title IV compared to Title I is far more open-ended in terms of what this terminology means. A great deal of attention has been given to taking equities and warrants, and Treasury must take equity or warrants if the loan is made to an airline or national security business. That's the first chunk of $50 billion, and all other loans are at the discretion of the Treasury. In the case in which, for whatever reason, the structure of the company is such that taking equity does not make sense, senior debt with a reasonable rate of return will be allowed. similar to TARP, going back for those of you who are old enough, there's no voting power that can be attached to these securities. And I know what you're all thinking. Who negotiates all of this? Does Treasury or do you as a lender negotiate it? Those are good questions. Now, we're going to move down now to the mid-sized business lending category, which is a very, very broad category. And we've had innumerable clients saying, I'm bigger than 500 employees. I need to get my money. I need to apply. And the coverage is between 500 and 10,000 employees. Now, interestingly enough, there is not an obligation. You can still get a loan if you've got above 10,000 employees, but these are particular loan terms that are in this category because you are supposedly a mid-sized business. There's no interest rate. The interest rate can be no higher than 2% per annum. This was fought out and is a very, very big deal and has been welcomed by the business community. If you're in this category, no interest or principal payments need be made for the first 6 months of the loan. We're interpreting that as meaning that the interest would accrue, but payments need not be made. There's similar to Title I, there's a retention or recall obligation of 90% of your workforce. The business must be domiciled in the United States, and we're of the view that a U.S. subsidiary of a foreign corporation would qualify for these payments, but the application of the payments would be directed towards U.S. operations and U.S. business. You cannot be involved in a bankruptcy proceeding. No dividends may be permitted until repayment or securities, and that's similar to the general obligations. No outsourcing of jobs for 2 years until after 2 years following the repayment of the obligation, and the business cannot abrogate a union contract during the period of the loan. Now, we've received questions as to whether or not Title IV loans have to be secured. The answer is probably not, but a lender, this doesn't prevent a lender from requiring security. And part of this is that these loan programs, as described, very, very open-ended, and we're going to have to see whether or not Treasury and the Federal Reserve Board decides to lay down specific rules in order to be able to approve the credits. And they also are supposed to be issuing procedures within 10 days following the adoption of the Act. Highly unlikely, and as Ken was mentioning, they can't even get the small business loan application correct. And you're also thinking, my God, there are a lot of loan terms and conditions. What are we going to do in terms of loan documentation? How is this all going to work? Those are very, very significant issues. And for those of you that are in the high-end lending business, we're talking about very, very complicated loan documentation, which is typically required, as well as complicated due diligence and investigations. There are special terms for airline businesses and national security businesses, and just very, very quickly, for those entities where individuals have compensation over $425,000, the salaries above that amount are frozen for 1 year. For those fortunate few that make more than $3 million a year, there's additional limitations that have got to be computed. And severance for pay is, for high-end individuals, is limited to no more than twice the annual total compensation. In terms of loan administration, again, this may be an area where these loans might end up being lucrative to be doing. Loans and servicing fees are not addressed in Title IV, unlike Title I, where they are somewhat addressed. But I mean, for example, in Title I, it doesn't talk about loan processing. It's a small fee, but favorable interest rates not to exceed 2%, which is important here. The interest rate for the larger businesses is not addressed. So if you go above the 10,000 employees, the rate may be higher. Now, Treasury is specifically authorized to hire staff and can hire fiscal agents to implement the programs. And reading that language, you can come to the conclusion that they might end up hiring financial institutions, i.e. banks, to be able to administer these programs, the Title IV programs, as opposed to the Treasury or, God forbid, the Federal Reserve to be negotiating these things. And the authority under Title IV expires in December 31st of this year. We'll stop there, and just so you know, this morning we had a call with Treasury in which we were asking some of the questions that I know you're thinking about, which is this going to be a loan program? Is this going to be a guarantee program? How does this interface with the Federal Reserve Board's credit facilities that they're talking about? And we received some very welcome clarity. Absolutely nothing has been decided yet. Everything is on the table. We can't really tell you much at all, but if you've got some ideas, we'd be happy to hear from you, which is being somewhat cynical or sarcastic, it's somewhat disheartening in that we're talking about the needs for very, very large, actually for mid-sized companies to qualify for these funds. It is going to be complicated. As you can tell, the terms and conditions have to be worked out. Language has to be worked out. And we're not even close to getting to the point where they can tell us what they think the programs would be. They do not get a gold star. And having said that, now I'm going to turn it over to Tom Scanlon, who's going to talk about some important consumer protections which are built into the Act. Tom.
Thanks, Joe. Good afternoon. In this section of our presentation, I'll address 3 sections of the Act that relate to consumers. 2 sections involve relief via forbearance on covered loans, and the 3rd section of the Act that I'll address involves consumer reports. Section 422 of the Act provides relief to a consumer who's obligated on a covered loan. And if during a covered period, which the Act defines, the consumer experiences hardship due to the COVID-19 emergency, the consumer is entitled to request forbearance on that loan. And if the request is made, then the servicer must forbear for at least 180 days. The law is designed to operate simply upon the request of the consumer with minimal documentation and contemplates there be a simple attestation relating to the hardship condition. Relatedly, this section 4022 imposes a moratorium on foreclosure actions involving covered loans, and a servicer may not initiate any foreclosure. A wide range of foreclosures are prohibited here as of March 18 this year. Section 4023 applies to a multifamily borrower, and similar to the program relating to a single consumer borrower, if a multifamily borrower had been current on a covered loan as of February 1, and the borrower experiences hardship due to the COVID-19 emergency, then the multifamily borrower is in a position to request forbearance on that covered loan. The forbearance period is shorter, starting with 30 days, but here again, the statute is designed to facilitate ease of administration by requiring that the financial hardship be documented, but without any specific conditions attending to that hardship. If during the period of forbearance, the multifamily borrower is thinking about initiating eviction or requests the tenant to leave, well, that can't happen. The law provides that during the period of forbearance, the multifamily borrower may not initiate an eviction action or give notice to a tenant to vacate. As an aside, I'll note that in my experience in federal government service, I've worked on several pieces of legislation as well as regulations adopted by the agencies. And these two sections, 4022 and 4023, are distinctive because they appear to be freestanding laws. There's no indication at all that Congress has delegated authorities to one or more federal agencies to prescribe rules as to how these laws should apply. Section 4021 of the Act relates to consumer report. And for context, we should note that if a creditor chooses to furnish information to a consumer reporting agency, then the Fair Credit Reporting Act imposes an obligation on the creditor to furnish accurate information. This new amendment to the Fair Credit Reporting Act relaxes that obligation relating to the accuracy of the information and generally is designed to allow the consumer to have his or her credit account be reported as current if the consumer and the creditor have agreed upon an accommodation. The accommodation needs to be negotiated during the covered period, which runs from January 1 of this year to the end of the national emergency. And if the account had been delinquent during that time, then the consumer is permitted to bring the account current and the furnisher must report that fact accordingly. By contrast to the other two sections, 4022 and 4023, this section 4021 amends the Fair Credit Reporting Act, and thus the Consumer Financial Protection Bureau, which generally holds rulemaking authority for that law, may offer guidance as to how this new amendment to the FCRA could or should apply.
Thank you, Tom. Just as to digress for a moment, in terms of these foreclosure issues and moratoria, we should note that what has not been given a great deal of publicity, but is another disaster in the making, is mortgage servicing companies not having sufficient amounts of capital to be able to conduct their business, including in many cases making obligatory advances to security holders. We are aware of the fact that Secretary of the Treasury and others in the administration have been apprised of this issue. It is a very, very significant issue which is going to move down the line over the next month and a half. Quickly, we're going to through a number of miscellaneous components of the Act for you, so you're aware of them. One is for national banks, you've got your lending limit in Section 84. It's been temporarily modified so that the lending limits do not apply for making loans to non-bank financial institutions. That is a very, very, very broadly defined term, which gives you some flexibility for a financial service company, which is not a bank, to be able to extend credit beyond your lending limit. The community bank leverage ratio has been, which is set at 8% by statute, and if you fall below that, you have got a grace period up until the end of this year to be able to reach that level. And as you know, that implies certain limitations will be raised and will be waived in terms of your operations. The banks were successful in getting a suspension of the CECL standards. That's the current expected credit losses, which everybody hates except for the accounting gurus, and that has been further extended by the federal regulators this last week, saying that CECL full implementation has now been extended for up until 5 years. It's a problem which probably nobody thinks is there except for the accounting folks, and you can probably tell how I think about it. Other miscellaneous issues, there's a provision that authorizes the FDIC to engage in direct loan and guarantee programs, impliedly only for FDIC-insured institutions. It was an authority that the FDIC had many years ago, and it's now reinstated, which allows them to be able to buttress the the operations of institutions that may be experiencing capital problems or maybe deposit problems. Conflicts of interest, we have talked about the ability of many folks to be able to obtain loans both under Title I and Title IV. There's a specific provision stating that the President, Vice President, and heads of agencies and members of Congress cannot receive financial assistance, and they cannot use family members in order to be able to circumvent that prohibition. There's also a bankruptcy code for bankruptcy folks, which effectively prevents a creditor from claiming emergency payments made by the government who are made under the National Emergencies Act, and it raises the dollar amounts which need to be looked at, particularly as folks are going to be going into bankruptcy, and our view is that there may be a number of bankruptcies filed in the coming months. We've talked about a lot of issues here, and as banks, we're all required to look at things from risk management perspectives, and I thought it might be useful to take a look at some of these things, again, when you're putting it within a risk management matrix, much of which are legal risk management, but they extend to other things, including credit risk management. One is the issuance of Treasury regulations. The SBA and the Federal Reserve Board and the OCC hopefully will be issuing things. Recently, they've issued several pieces of paper which are not regulations. They're, for the most part, poorly written instructions, which has created controversy among the industry. The complexity of the Treasury regulations, we think, is going to end up being significant because, as we mentioned before, as issues come up, things need to be clarified. I know that Ken was talking about the affiliation rules. In terms of Title IV, there are so many things there in terms that have to be necessary, and the degree of due diligence, inquiry, negotiation that have to take place. Again, an issue, and when they come out, whether or not you want to take those into consideration. I believe there's a very, very significant issue to the extent that these programs, certainly Title I and maybe Title IV, are going to require compensation on the back end for insurance. The SBA would retain the ability to do back end audits and disqualifications of payments which are relied upon by the bank. And we have already received comments from many banks that they are concerned that if it is not done properly, after the fact audit will disqualify them from what they're doing for purposes of relying upon the guarantee. And as Ken mentioned, there's a new document that's hot off the presses, which talks about the representations being made by lenders, which in itself implies the fact that their certifications and theoretically, if they're not made correctly or if they're false, there could be liability. There's also operational concerns such as staffing, training, and technology. You've got existing SBA loans, and we're kind of used to doing that. Most staffs at banks for SBAs is relatively small. That has to be expanded. You've got training issues which have to be considered, and certainly in terms of Title I and, of course, Title IV, it would be significant. Program duration. The program duration, frankly, we're of the view probably does not work and will have to be significantly expanded. That would be either done during an amendment to the existing legislation or as part of a fourth version of stimulus that is being considered. It's also important from the bank's perspective to look at revenue projections and whether or not you can make this work. Higher end loans theoretically could become lucrative, could be worthwhile. Again, if they're lowering down the rate to 2 years and 0.5%, it becomes questionable. Whether or not that is a rate which would be imposed on the borrowers and yet would be supplemented by the SBA remains to be seen. We'll have to see whether or not that works. Client selection. What we are finding in our conversations with our clients is that the banks feel they may be overwhelmed, and what they're looking at is dealing with their existing clients as opposed to new clients, because there's the need to get the money out quickly to get these loans processed, and that's a consideration. And then you've also got the capital and lending capacity, which we mentioned a few moments ago. As to that requires looking at your assets and your capital limitations. Talking about bank regulatory advice and guidance, we've got two components. We've got safety and soundness, and then we've got monetary policy. You've got the four principal agencies. I'm not counting the CFPB, because they should probably just stay put, keep their mouths shut, because this is a safety and soundness problem. It's a credit crisis. It's not a liquidity crisis, at least yet, and yet the Federal Reserve Board has put in place credit facilities in case that comes to pass. The announcements by the banking agencies have predominantly been issued by the FFIEC or by joint agency announcements, and for the most part, they deal with the same types of things that you get in the mail or in the email after natural disasters in your neck of the country: emergency preparedness, operations, filing of core reports, and we can expect that these things will continue to be amended probably on a weekly basis. For example, there's now an interagency statement on business impact analysis, which attaches an addendum for pandemic planning, and I'm not aware of many banks that have got a special component of your impact analysis dealing with pandemic planning. Well, it's there now, and the next time the bank examiners come in, you're going to have to look at it. Bank operations, pretty self-evident things. You've got a great deal of leeway in terms of operating your bank. You do not have to notice anyone if you decide to do branch closings, and the banking regulators will give you reasonable accommodations in terms of using electronic filings for things. They also came out with a statement on retail customer activities, and again, some things which you probably need to be doing with your customers, because that's what banks do with their customers. Looking at overdraft fees, ATM fees, waiving early withdrawal penalties. There's a whole host of things you can do which may cut down slightly on your fee income and yet are very worthwhile doing. Bank default and forbearance. On Sunday the 22nd, the agencies came out with something which directly addresses loan defaults and modifications, and the basic advice is that you can grant a loan modification, including a mortgage modification, and as long as the borrower is not in default, that will not constitute a TDR, and that's a good thing. However, at some point, you may have to set up and modify your ALLL, and that's something that will have to be looked at depending upon, again, what the condition of the loan portfolio is and the condition of the individual credit. I will note, however, that the banking agencies and also the CARES Act liberalized the TDR exception, saying that it will now apply to loan modifications instead of being current when the modification takes place. It can be up to 30 days delinquent, which is a more liberal standard, and that is a good result for the industry. Quickly talking about monetary policy, if you recall back in the subprime mortgage meltdown, the Federal Reserve Board used its substantial, almost superpower under Section 13, Sub 3, to protect individual industries, individual companies, and there was a backlash against that, and it was amended to indicate that it can still use the power, but must use the power to protect the national economy. And what the Federal Reserve Board has been doing within the last 30 days is standing up or announcing mostly liquidity facilities for various components of the financial services part of the economy, in order to be able to provide liquidity, thinking that this may again quickly turn from a credit crisis into a liquidity crisis. And we've listed some of those components here for you to be taking a look at, including, as you know, they lowered down the federal refunds rate to less than 0.25%, and the bank reserve requirements down to 0. Interestingly enough, the Federal Reserve Board did announce the creation of something which has really raised some questions, the Main Street Business Lending Program, which is a facility they will operate separate and apart from Title I, and everyone is trying to figure out what is going on with that. And so far, we don't really know, but we might be able to speculate. And having gone through many, many components of this act, I'm going to turn it back over to Nick for a moment.
Thank you very much, Joe. That was, and the rest of the panel, that was terrific. I wanted to let everybody know in the audience that today's session has been recorded, and you'll receive an email link that will allow you to review the presentation again starting on Monday. You'll also have access to a playback recording of another very recent Dorsey seminar on the stimulus bill, as well as links to our coronavirus and stimulus resource center. And with that, I just want to say thank you for your attendance today.